What's going on, guys? MMuniz here. Welcome back to the channel. In this video, we're going to do a theoretical portfolio analysis on two popular income ETFs when combined with each other. The two income ETFs that I've chosen are RYLD and JEPI. Now, I've chosen these two specifically since they are on opposite ends of the spectrum when it comes to their holdings and volatility. So let's find out. Do opposites attract? Are these two funds meant for each other? Now, before we get into the video, I do have to give a few disclaimers. This video is not financial advice. This video is for entertainment purposes only. My goal is to get you guys thinking outside of the box, do your own research, and then do what's best for you and your family. We also need to realize that this video relies heavily upon past performance, which doesn't necessarily indicate future performance. We can only use it as an aid to help us forecast the future. So first things first, what is the point of having a portfolio with these two holdings? Well, we wish to create a passive income portfolio where you're maybe in retirement already, or you're close to retirement, or you're just looking to benefit from those sweet, sweet dividend payments every month, basically discretionary income. We're gonna have a lump sum investment, and you can change the amount, but we'll do $50,000. And we're not going to reinvest dividends. The dividends are what we're gonna use to pay for our expenses. Lastly, we're not gonna be selling any shares at any point. So the hope would be that our initial lump sum investment either stays the same, or even better, it goes up. So the blend is gonna be RYLD and JEPI. Let's break down those two holdings individually. So starting with RYLD, we have an income ETF that holds stocks from the Russell 2000 index and sells monthly covered call options on that same index. You have a relatively high expense ratio of 0.6 or $60 on $10,000 invested. Now, the reason for this is because the fund saves you the time and money of writing your own covered call options, which can be challenging. It can require a lot of research, and also a lot of times it requires a lot of investment up front. Now, the objective of this fund is to produce similar investment results to the underlying index. RYLD's trailing 12-month yield is actually an impressive 14.5%. Wow. In general, you could expect a 12% distribution, or basically 1% monthly on each share that you hold. Now, some quick notes on the underlying index that RYLD seeks to generate similar returns to. The Russell 2000 is a market index comprised of 2,000 small cap companies. It's rebalanced every June. Now, the way that the funds are included in the Russell 2000 is it takes the bottom 2/3 market cap from the Russell 3000, which is comprised of actually around 98% of America's publicly traded stocks. So with the Russell 2000 holding smaller market cap stocks, what exactly does that mean? Well, typically with smaller cap stocks, you're gonna have more volatility. Remember, more volatility means it can drop down faster, but it can also go up faster. However, with RYLD writing the covered call options, you're capping that growth. So you can see significant declines, but you're not gonna see the quick bull run, parabolic growth in the net asset value. So just keep that in mind. Now let's talk about the second fund in this theoretical portfolio, JEPI. So JEPI is basically the opposite of your RYLD in terms of its holdings. The JP Morgan Equity Premium Income ETF, it's kind of hard to say, is an actively managed fund that seeks to deliver monthly income and provide market exposure with minimal volatility. So once again, the opposite. They do this by holding mostly large cap stocks that meet the requirements of the fund managers when it comes to their expected risk factor. JEPI also writes options to provide higher monthly income through their equity-linked notes, or ELNs. The current trailing 12-month yield is actually just under 8% at 7.89%. Now, this is pretty impressive, all things considered, when you consider that you still have upside potential, which RYLD does not have. Now, that was a real quick breakdown, but if you want a more detailed video or description of how JEPI works, look down in the description below. I have a link for a YouTube video. It's made by one of my buddies. His name's Cody, Citizen of the Year, and he has probably the best video on YouTube right now for explaining how JEPI works, basically. So if you're looking for a more detailed description, go ahead and check out that video. It's fantastic. So now that we've broken down both of the ETFs, let's take a look at a few blends of these ETFs using one of my favorite websites, Portfolio Visualizer, which I have linked down below as well, and it's free to use, so I recommend it. Let's check it out. So something that's important to note is we don't have a lot of data for both of these stocks. RYLD was started in April of 2019, and JEPI was actually May of 2020. However, we can go back to April 2019 because we can actually use JEPIX for the history, which is the same as JEPI, it just has a higher expense ratio. So that's what we did for this. So with the Portfolio Visualizer, you can see here, we started with an initial amount of $50,000, and you can change that to whatever, but this is just the number that we're using for this example. we're going to rebalance annually. So that means that if you have more money in JEPI at the end of the year, you may use some of that to rebalance into your R yield. We are not going to reinvest dividends because remember, the idea of this portfolio is to create passive income where we're going to use those dividends. We want to inflate our lifestyle or pay our expenses, we quit our job, whatever. We're not going to follow any benchmarks, but we're going to have three portfolios. We're going to have a 70-30 mix, a 50-50, and a 30-70. Obviously, these are going to be a mix of R yield to JEPI. So the heavier portion would be R yield for the 70-30. 50-50 is perfectly balanced, and then the heavier portion for the 30-70 is going to be the JEPIX. So we can come down here. We're going to click Analyze Portfolios, and we're going to see our results. Now, the important stuff is I like to go to the portfolio returns. So we started with 50 grand, and as you can see, our balance did go down. So we did lose some of our nest egg, even though we didn't sell any shares. However, it's important to note that from November of 2021 until today, in May of 2022, we've been seeing significant declines across the entire market. So it's not unheard of for us to be a little bit lower than our initial investment. What we don't want to see is we don't want to see massive crashes without it coming back. And this gives a good example of back in March of 2020 during COVID, it did drop and then it did come back. So remember, just because our yield doesn't go up exactly with the index, it still does see net asset value increase, just not quite as fast. And you can see that when we look at the graph. For instance, the blue line that goes the lowest is obviously going to be the 70-30 mix of R yield to JEPI. The more R yield you have, the more volatile your balance is going to be. You're going to see a bigger dip and you're going to see less of an increase. So from the bottom of the dip all the way up to the best point, we have lower for that whole thing because that's exactly what R yield does, is it's going to participate in the drops, but it's not going to follow the increase as much as JEPI would, for instance. So if you have more JEPI, which uses the large cap stocks, less volatile, you're going to have less of a dip and you're going to have more growth over time. Now, the next important thing though, is we're going to keep going down and we're going to go down to what I like to look at, which is the portfolio income. And the reason that this is important for this portfolio specifically is we have to realize that just because our yield has a better return right now doesn't mean that it always did. So back in 2020, you'll see that the 70-30 mix, which is more R yield, had less returns than the JEPI one. Now, yes, in 2021, when we were pretty much in a bull market, our yield did take back over and had a better overall annual return. And then in 2022, it's been pretty even. So honestly, if you were to talk to me, I would say that the 50-50 mix is the best because you're going to see a decent amount of large cap, a decent amount of small cap, a little tiny bit of mid, and you're still going to have strong returns. It's not like, you know, if you hold more JEPI, you're going to significantly decrease your monthly return. So just keep that in mind. The next thing I want to talk about, we're going to go up here, we're going to look at the exposures, and this is exactly what I was just talking about. The 50-50 mix, we have a 48% small cap stocks, then we have a little portion of mid cap, and then a high portion of large cap. So we have a really good balance. You know, that's why I say the opposites attract. I think that this portfolio, these two funds, is pretty strong just because they're so different in terms of their holdings. We can also go, and I like to look at the annual returns, and this is important to look at, and the reason is it shows that if you have a higher amount of R yield, yes, you're going to see a higher yield here, 11.89% versus 10.9, but it's not that different. You know, if you keep it at 50-50, you still have 10, 11, and even though this says 6% here, that's only because we started in April. We do not have the first few months. But overall, our returns for the 50-50 mix are pretty strong. I don't think it's worth having more JEPI, and I also don't think it's worth having more R yield. I personally like the 50-50 mix, and we just need to realize, you know, yes, yields are down right now, and yes, our initial portfolio value is down, but so is the S&P 500, so is the NASDAQ. That's just the market we're in today. If anything, these income ETFs are actually outperforming because they're capitalizing on options premiums. So now that you've seen the performance of when you blend the two ETFs together, one thing you got to remember is the taxes. Now, if you have R yield, you're going to be most likely paying ordinary income taxes, so taxes at your highest bracket. If you have JEPI, you're going to be paying the same, but you're also going to have some qualified dividends. Not as many, but still some, so just keep that in mind. So if it says you're getting a 10% return, realize that some of that is going to have to be set aside to pay Uncle Sam. So at the end of the day, what do I think? Well, a lot of people think, oh, I'm going to put a ton of money into Q yield or a ton of money into R yield. And yeah, you can do that. But I think if we have the blend of, for instance, Q yield and Devo or R yield and JEPI, I think you're going to be a lot more successful if your only goal is to just collect income on a monthly basis, because you're protecting your nest egg. You don't want it to dwindle away to nothing, and then all of a sudden your actual distributions are going down as well. So I think with these blends, you're in a lot better shape than if you were to just individual in one of the high income ETFs alone. And also, I may be a bit weird for this, but I like to have multiple bank accounts and multiple brokerage accounts. So for me, for instance, I have an M1 portfolio that is mostly invested in aggressive growth stocks, and I have a 5 to 10 year plan where I'm going to sell those off at some point when I think it's a good time to buy some real estate or a rental property. So for my family and I, that's our plan. It's a way we're investing. At least that's what I think we're going to do. Maybe I'll just buy a Lambo. We'll see. I also have my Robinhood portfolio, and that one is a 10-year plan where after 10 years, then I'm going to reassess. Maybe I'll inflate my lifestyle a little bit, but for now, nothing is being taken out of either of those accounts. And then lastly, I have a third account, which is my retirement account. So that's like my 401k. That account obviously is not going to be touched until retirement. So I like to have different accounts with different approaches to my investing and my personal finance. So something like this could be used for anybody, whether they're close to retirement, in retirement, or they're like me and they just want to have one separate account where they put money into that pays them out, and then they can use that to go on vacation or buy a new car or do whatever they want to do. So remember, it's always good to diversify and plan for the future to save yourself some stress. So the last question is does this duo beat the dynamic duo, the Q yield and Devo? Well, personally, I like Q yield and Devo a little bit better, so that's what I'm doing for my passive income. But this is a great option too. As long as you stick to the plan, you're not pulling shares out, and you're just using the dividends and the distributions, then you're getting paid passive income to do nothing. So I don't have any problems with that, and whatever works for you. So if you're still watching the video, if you have any questions, comments, leave them down below. I do my best to answer all comments on all of my videos. And if you haven't already, make sure you smash the like button, subscribe to the channel. I hope to see you guys in the video next week. And until then, take care.